Good afternoon to all our speakers, panelists, and also all our participants. Let me welcome you to this webinar that we are organizing this afternoon on a very important topic on the international sovereign bonds and impact of the economy. Now, this is one of the topics that we are considering in our seminar series, where we are looking at getting over the government debt problem. I think everyone knows that this is a serious matter of concern to everyone, but certainly we need to see how we can get over this. And I'm sure that today's topic that we are talking of on the international sovereign bonds and impact of the economy is one area which we can listen to and get to know. Just to tell you, I think all of you know about CMA Sri Lanka, but the Institute of Certified Management Accountants of Sri Lanka is the national professional management accounting body in Sri Lanka, which is incorporated by an act of parliament and a member of the International Federation of Accountants, a global body for the accounting profession. We are also members of the South Asian Federation of Accountants, which is the member body in the SAARC region. So as you know, as management accountants, we all have to play a very important role. But our specialization would be on, say, management accounting, financial accounting, and of course, strategic management and other areas. Although we talk of the different areas applicable in the economic area, I'm sure these international sovereign bonds would be an area which would be of great importance to all our members, plus also all those who are here from the private sector, the companies and other institutions. Now, today for this seminar, we have a very eminent panel that we have invited. We have our speaker, Mr. Dhananath Fernando. He is the Chief Operating Officer of Advocata Institute, Sri Lanka. Then we have two panelists with us. We have Dr. Anil Pereira. Dr. Anil Pereira, who is the Director, Economic Research of the Central Bank of Sri Lanka, and Mr. Adrian Pereira, who is a fellow member of our institute, and currently he is involved in Sri Lanka Rating Agency, where he is the CEO. So our first speaker for the day would be Mr. Dhananath Fernando. So I will briefly introduce him and also maybe briefly, I think I've already told who the others are, but I'll just speak first on our presenter today. Dhananath is currently the Chief Operating Officer of Advocata, an economic policy think tank in Sri Lanka, where he is a founder member. Advocata Institute worked extensively on bringing down tariffs on menstrual hygiene products in Sri Lanka, reforms of state-owned enterprises and micro and small enterprises. Advocata was ranked as the best upcoming think tank in 2017 and 18 at the Global Go-To Think Tank Index by University of Pennsylvania. Advocata report on SOEs in Sri Lanka beyond profit and losses made the list of best policy study reports by a think tank across the world in 2019. He read for his bachelor's degree in bioscience and biochemistry at the University of Colombo and is an alumnus of the International Visitor Leadership Program by the State Department of the United States of America. He was the winner of the Asian Think Tank Shark Tank Competition 2018 in Jakarta and a finalist for the Think Tank Shark Tank Global Competition in New York in 2019. Dhananath is also a curator and founding member of AK Litfest, a trilingual literary festival dedicated to showcasing local authors of Sri Lanka. In his social responsibility, Dhananath works with people in need by volunteering with Candlelight Lanka, a government-approved humanitarian organization. He was a part of a team training vision and hearing impaired students on swimming and safety, and the main coordinator for personality, career development, and English training for undergraduates. Dhananath is an enthusiastic trekker and a mountain climber. He completed the Everest Base Camp in May 2018. So we have someone not only with the knowledge of on the economy, but various other fields which will be of which has enabled him to get a greater understanding of what the society and the people need. So I now have great pleasure in inviting Dhananath to speak on the topic of international sovereign bonds and impact of the economy. Over to you, Dhananath.
Thank you very much, Professor Vatavala, for that kind introduction, and welcome to the discussion. And it's an honor to share the panel with Dr. Anil Pereira and Mr. Adrian Pereira. Thank you very much for the kind invitation. I hope I can keep the audience slightly interested on a Friday afternoon, because this topic is slightly debated and also somewhat technical. I have a few slides to share, which is quite technical. And if you are going through the joining this session over the phone, you might not be able to see some of the numbers, but I'll be able to share the slide deck later on. But just to understand the gravity of the topic, and also to make sure that you can understand it better. I hope you can see my screen now. Can you all see my screen?
Yeah, we can see it.
Okay, brilliant.
That's fine.
All right. So I'll quickly go through. First, my presentation is mainly just to have a quick overview on understanding what's the sovereign bonds, and also, since the broader topic today is on getting over this debt problem, I have a few recommendations towards the end, also by understanding the problem, what we are sort of dealing with. So just to understand what's a bond, I'll start with a small story, just for understanding of everyone. Now imagine there's a company called Company A, or you can put your name or any name, and that company wants to buy a factory for $1,000. But the problem is they don't have money. They may have money, but they don't want to interrupt their cash flow. So they have basically multiple options, but one option that they could consider is issuing shares. So if they issue shares, for an example, they can issue shares, one share at 10 rupees for 100 shares. So then they can easily collect the $1,000 and then buy that factory. But when they issue shares, of course, their profit will also be distributed amongst the shareholders. And even if they make a loss, the shareholders have to bear that loss. So that's option number one. The second option is actually they can issue a bond, which again, they will issue a bond of $10 per bond for 100 bonds. But in a bond, there'll be a maturity period. So they say we'll pay you back in 1 year, just as an example, or 10 years. And there'll be an interest rate of 10%. So those who buy a 10 rupee bond, at the end of 1 year, they'll get $10 as well as an interest rate of another $1. So in this case, they won't, the bondholders will not have the ownership of the company, but they'll also treat it preferably, because they are becoming, in your terms, liability of the company. They'll be, interest will be calculated as an expense, but no ownership of the company will be transferred to the bondholders. So that's the bond and a share. So in a bond, now we call it a coupon. Now this is like a bond of $20 issued many years ago. I'm sure most of you at school big matches and sports meets, that they give like a small token for your food and for your drink, where you tear off the food one first, and then you, to get the drink, you tear off the drinks coupon. So likewise, these bonds can be issued for multiple periods. It could be 1 year, 10 years, 15 years, 20 years. It can be multiple periods. So there'll be like a coupon rate. So earlier, many years ago, when this was issued, basically people after 1 year, they can go with that coupon, and when they hand over that coupon, they'll be given that money. So if they buy like $1,000 bond, and they go every year with the coupon, everyone will be paid like $100 at the maturity of every year to 10 years, and at the end they will be paid the $1,000 as well. So I have just put it in illustration just for understanding. So what is on top of is like year 1, year 2, year 3, like going up to year 10. So we have issued a bond of $1,000, a coupon rate at 10%, and maturity at 10 years. So every year this person will get $100 every year, and at the end of the 10 years he will get the $100 as well as the $1,000, which is the initial investment. So generally the bond coupons being paid like semi-annually. So every 6 months they will pay like $50 after 6 months, and the balance $50 at the end of the year. But it all depends on the terms and conditions of the bond. So that's a little bit about the bonds. So now when you buy a bond, basically that bonds will be traded also in the secondary market. So when a company issues a bond, someone can buy it, and I can buy it and sell it in the secondary market at a higher rate. So basically what happens is, now imagine the bond that I bought initially is at 10% for a maturity of 10 years. And because of some economic conditions, the interest rates are increasing. If the interest rates are increasing above 10% as an example for that particular investment category, so then my bond which I am holding is 10%, but in the market there are opportunities where I can buy more instruments for more than 10%, for 12%, for an example. So at that point, most of the bondholders who are having the 10% bond will try to sell the bond, because they have the option of buying instruments which are more than the current market rate. So when the interest rate increase, basically the price of the bond that I am having, which is 10%, the prices will fall. So even the face value of the bond is $100, the prices will fall. I may have to sell it for $90 or $85 or $95. So when the prices fall, we call the yields increases, and the vice versa can happen. Basically the interest rates may fall down to 8% or 5%. So then the bond that I have is offering 10%. So the demand for my bonds will increase. So then the prices will go up and the yields will fall. So that's the basic terminology of bonds, and how you calculate the yield rates. I'm not going to detail for the best interest of time, but that's how it happens. So like companies, the sovereign states can also issue bonds. So for an example, the Sri Lankan government can issue bonds similarly. And the advantage for a sovereign state is when they issue bonds, like when you go to get a loan from the bank, they will ask like, what is your retirement age, whether you can pay this loan, all sorts of, whether you have assets to back this loan in case if you default, all sorts of questions being asked. But for a state, they don't age, because, you know, a country can run over and over again. They don't basically age like a person. So they can refinance this debt. So basically Sri Lanka has also, in terms of sovereign bonds, we have issued sovereign bonds. It can be dollars, it can be issued in dollars or yen or renminbi or any currency. So basically, the international sovereign bonds are mainly under New York law. And also we have issued dollar denominated bonds called Sri Lanka development bonds, which is under the Sri Lankan law. Also we need to understand now, imagine the Sri Lankan government issue like a $1 billion bond. So people will come and buy those bonds. And in the modern world, now imagine I issue that bond to mature in 1 year. So after the 1 year, ideally, if I issue a bond of 1 billion, so ideally I should invest that money in a project or in an investment which will brings me a revenue which I can pay the interest as well as the initial investment for the money that I have borrowed. So if I am not investing that money, something that brings me revenue, also in dollar terms, I may be having a problem. But the advantage for the sovereigns are, or like the countries, they can go and roll it over. So they can go to the market. I issue a bond today for 1 billion and it matures after 12 months. Let's say we fast track to 31st of December in 2022. So I have to pay back, but I need not to really pull out the money from my kitty or maybe in the reserves, but I can go to the market and issue a new bond of 1 billion and settle that previous bond, and I extend for another year. So basically most of the countries does the same thing. But we can do that as long as the market is willing to give us money. If the market is willing to give us money, more money, and then of course we can go back to the market and borrow more and again pay our previous debtors. So that's something that we need to keep in mind in this international sovereign bond business. So the market access is very important in this sovereign bond because we can roll it over as long as the market is willing to give us more money to roll it over. So that's what we have to keep in mind on the bonds. So in terms of when we issue a bond, I'm just like, this is a newspaper article or like a web article. So when the government issues bonds, they issue it through you call the lead managers. So in this case, this is in 2019, the government has, when they issue the bonds, not that if you are interested to buy a bond, you can't directly go to the central bank or the government of Sri Lanka and buy it, because the government of Sri Lanka shortlist or appoint the lead manager. So in this case, in this particular bond series, which was issued in 2019, the government has selected HSBC, Standard Chartered, JP Morgan, and Deutsche Bank and Citigroup and some other institutes as the lead managers. So they will go and buy the bond, and then they will sell it to more people like fund managers, those who are people who are interested, of course, keeping another margin. So that's how it happens. So basically companies like HSBC, they have a advantage to sell bonds in the Asian markets. Likewise, so these are like big bonds, 1 billion, 500 million. So these banks should really have or the lead managers should have the speciality to go to the investors and sell these bonds. And basically the pension funds, the insurance companies, they come and buy these bonds. And in fact, the Sri Lankan banks, like the Bank of Ceylon, the commercial banks, they also come and buy these bonds, because this is fairly a secured way of investing your money, because the government is assuring that they will pay. And as I said, they can go back to the market and again raise funds and pay you back, and you get an interest as well as at the maturity you can get the bullet payment, and also you can sell it in case, even without waiting for the maturity period. If you want to sell it, if you want more money, you can sell it based on the market consequences and cash it. So the agent really will know who actually bought the bond, because I may buy it from the HSBC and I may have a cash need, so I will sell it to Professor Vatavala, and Professor Vatavala will sell it to Dr. Anil, and Dr. Anil will sell it to Mr. Adrian. So likewise, this transfers from one person to the other, and through a custodian they can get to know like who owns the bond. But basically the bondholders, unless it's like the fund manager or whoever who discloses it, or like the bondholders discloses themselves, we really can't know who owns that particular bond. I hope I'm clear. So now I'm moving for the Sri Lanka's debt situation. So Sri Lanka, of course, have debt in multiple channels. We call domestic debt, which is in rupees, and also we have dollar debts. So this chart shows from 2000 to 2021. Dr. Anil is here. He probably have the updated data, but this is according to our sources. We have about 17 trillion debt as 2021, and the 2021 number is estimated. And what you see in the pink line is the increase of the debt over the year. So in 2021, our debt stock has increased by about 17%. And in 2020, again, our debt stock has increased about 16%. So that's the debt stock that we have. And this shows to whom basically our debt to GDP ratio. GDP is like the total value addition on that particular year, like the total production that we do for that particular year, and as a percentage of our debt. So what you can see is our debt to GDP ratio in 2021. If you look at the left hand column chart, as you can see, it's 107%. I have compared it with the regional peers as well, with India, Vietnam, Malaysia, Thailand, Philippines, and Bangladesh. And of course, on the left-hand side, you can see how the debt to GDP ratio increased from 70% to 107% from 2017. But the important point is, I think everyone looks at the debt to GDP ratio, but I think a more important figure is our debt relative to our revenue. So if you look at our government revenue, that is like the income, it is about, in Sri Lanka, it's about 1,264% as a percentage of our revenue. But as you can see, Bangladesh, Philippines, they are fairly at a lower percentage. And as you can see, from 2017, it's increasing. I'm coming to the reasons why it's increasing at a higher rate. But compared to our revenue, I'm just want to give you like an understanding of our debt stock. But of course, you need not to worry you have to worry about the debt stock, but all these debt you need not to pay on like next Sunday morning. You have time, because some of the debt maturing in 1 year, 5 years, 10 years, 20 years, 30 years. The maturity period is also spread across. So you need not to worry like, okay, all this debt need to be settled like, on a Sunday morning. You have time. But what we have to see is whether it's sustainable. So on understanding the debt sustainability, now why some people think debt is a problem, but some people think it's not a problem. But this is also from a research study. Basically, what you see on the left-hand chart, the water flow graph, is our credit, like our debtors, our credit to the private sector is what you see in the purple color, and the ash is like the debt or the credit given to the government, and also our credit to the state-owned enterprises. State-owned enterprises is like the Ceylon Electricity Board, Petroleum Corporation, Sri Lankan Airlines, the Sri Lanka Ports Authority, likewise. So as you can see, over the years since 2000, we have got the data since 2015 January, our debt is increasing. Pretty much on the credit to the government is increasing. If you look at the ash color stream, that means government taking more credit, and the private sector credit, or like private sector also taking credit, but that's also increasing. But if you look at the government credit, is increasing at an exponential rate. Now, the problem with too much debt is, if you have too much debt, now what you see in the right hand graph or like the chart is basically, if your debt to GDP ratio is between 0 to 30, you can have especially for emerging markets like Sri Lanka, in our profile, it's about we can achieve like about a 4% growth. But as you can see, if the debt to GDP ratio, when it's increasing for 30 to 60, from 60 to 90 and above 90, our economic growth is slowly coming down. Because that you call the debt overhanging problem, because when you have too much debt, your resources are being absorbed and you can't really drive the economic growth. And that is the problem. So as you can see, as you can understand, debt to GDP ratio, that means debt over GDP. So if your GDP is growing, your denominator is increasing, so your debt to GDP ratio is coming down. And this is like the entire profile of our foreign debt and our domestic debt. So we have given it in mainly in rupee terms. So in the left hand side, you can see the foreign debt. And of course, it's not only the international sovereign bonds. We have international sovereign bonds for about 11.8 billion US dollars. Just to give you like a visual indication, I'm sure many of you are aware that the Sri Lanka Hambantota, there's like a port deal in 2000, I think 17, 18. So what we got from that Hambantota port rent or lease agreement was about 1 billion. So 11 billion USD on the ISBs is about 11 times of that Hambantota port deal, just to understand the quantum of the debt. And also we have project loans, we have non-project loans, we have treasury bills, we have treasury bonds on the domestic debt, and we have a foreign debt on the left hand side. And also on the right hand side, we have shown to whom are we owning this debt. As you can see, I will explain who are the multilaterals, bilaterals, and financial markets. So basically, these international sovereign bonds mainly coming under financial markets, financial market debt, which is slightly the interest rates are higher, and multilateral debt and bilateral debt is also there, and we owe also for central bank and commercial banks as well. You can go through it in detail when you have time. So this is our foreign debt portfolio. So it's not only, as I said, the financial markets. So we have multilateral debts. What I meant by the multilateral debts, it is basically the organizations like Asian Development Bank, World Bank, and others. So we have about 8.5 billion US dollars, in other terms, like 8 times of Hambantota port, which is about 24% of our total foreign debt. Is on the multilateral, and we have about 18% on the bilateral. That is like friendly countries. You go to Japan, you go to the government of Japan, India, China, and other countries like France, Australia, and we have about another 6%, 6 billion US dollars of debt for these countries, bilateral. And then we come to financial markets. So Exim Bank of China is also coming under financial markets. As you can see, more than half of our foreign debt is in financial markets. So about 34% on the total is on the international sovereign bonds, which I explained, that is the market debt. And also we have another 8% on Exim Bank. Also, there's like a lot of conversation whether we owe too much for China and all that. As you can see, actually the China, if you add the bilateral debt with China and the Exim Bank of China, it's about 10%. A similar percentage for Japan. So, and our market debt is more than that, which is the international sovereign bonds. So when it comes to debtors, basically the multilateral debtors are, we call them the senior creditors, because they are provided concessional loans. Basically, their interest rates are very low. They give mainly for non-tradable loans, and they give it like a longer maturity period, like to pay the debt in like 10 years, 20 years, 30 years, very low interest rates. And maybe sometimes very concessional loans, they provide like grace period. That's why a lot of governments prefer to work with IDB or ADB, Asia Development Bank. And Japan is one of the main lenders for Asian Development Bank. And then we have the bilateral creditors, where there's like a lot of geopolitical sensitivity comes in. They also provide loans on project basis. And also then the third is the market securities, or like the debt securities. Now this is our domestic debt. That is mainly on the rupee terms, but also there are some domestic debt also in dollar terms. I'll come to that. So our main domestic debt, mainly short term, is on treasury bills, which is about 17%. In Sri Lankan rupee terms, about 1.6 trillion rupees is our debt stock, short term treasury bills. Of course, central bank owns about 7%. And as you can see on treasury bonds, which is long-term, slightly long-term, medium-term, it's about 63%. And out of the treasury bonds, we have a bigger exposure for EPF, Employee Provident Fund, which is about 28%. And there are others. So as you can see, the Sri Lanka development bonds, which I mentioned very early, we have issued Sri Lanka development bonds also for about $2 billion, dollars, 2 times of Hambantota port. And also we have international sovereign bonds also on the local debt portfolio, which is about 4% from the local debt. That's the portfolio on the local debt. So then comes this problem of debt sustainability and international sovereign bonds. So as you know, just to recap, we have foreign debt and local debt. And out of foreign debt, about 57% is on the international sovereign bonds, which we spoke a little while ago. And international sovereign bonds basically issue in dollars, dollar terms, and generally we don't pay it on our reserves as long as we can finance it from the market, because the governments have that ability. They don't age, so they can go back to the market and finance more as long as they invested the money in revenue generating projects. So the debt sustainability, what you call a debt, if the debt sustainable means that any country can, without any restructuring, defaulting or renegotiation, that country can pay their debt commitments, is basically considered as the debt sustainability. So basically the market perception, external financing requirement, the change in the share of short-term and long-term, and public debt held by non-residents and foreign currency debt, these all are considered in the IMF debt sustainability analysis, which basically we assure like the country's debt is sustainable or not. Now, when you look at the debt to GDP ratio, mainly there are multiple problems or like multiple factors that contribute to the debt to GDP ratio. Now, what you see here is from 1999 to 2020, what contributes to our debt stock. So as you can see, from 1999, our debt stock has increased. So from the debt stock, which is increased from 1999 to 2020, 75% of the debt stock has increased due to the interest payment. So that means simply we have borrowed too much of money on short maturity in dollar terms. In dollar terms, short maturity to pay the interest as well. So as you can see in this pie chart, about 55% of our debt stock increase contributed by the interest that we paid, because we have borrowed money to pay the interest as well. So we have borrowed money at a higher interest to pay the interest of the previous loan. So that was the main contributor of increasing the debt stock, which you can see in the purple color. And the second is also the exchange rate variation, but you can see it's like in the dark ash color, because when the rupee depreciates, with the exchange rate variation, when you calculate the dollar loans or dollar borrowings in rupee terms, with the exchange rate depreciation, that also add to the debt stock. It doesn't mean that actually you have to pay that amount, because anyway you have to pay it in dollars, but that adds to the debt stock. So those are the two contributory factors. And also there's another factor called primary balance, which is excluding the interest, the primary balance that is considered that your revenue minus your expenditure without the interest, that is called the primary balance. So we are running a primary balance deficit that is also contributing. Those are a little technical, but what you need to understand is mainly from this slide is basically 75% of our debt stock increased due to the interest paid from 1999. That means we borrowed more money at higher interest rate just to pay the interest of the previous debt. And this is what you can see also. We have not only the government has taken borrowed money, also our state-owned enterprises have also borrowed money. So as you can see, the public, there's through the treasury guarantees, a lot of debt has been taken. As you can see, Petroleum Corporation in 2020 CPC contributes a lot for the state-owned enterprises debt. Road Development Authority, Water Board, CEB, SLA, Defense University, they all have taken money under the state-owned enterprises. Now here, also what you can see is the government debt and its cost is also increasing. Now in 2020, we have to pay about almost about 800 billion rupees, about 980 billion rupees as the interest cost to service our debt. So almost about 1 trillion rupees just as interest. So that's the problem. So Sri Lanka's from the revenue, we have to pay about 70% as interest payments from the government revenue. So for all our, including debt servicing, we have to pay about 140% of our revenue with the total of debt servicing without any other expenditure. So that is one of the main problems. As you can see, recently our domestic interest component is going up, but foreign is slightly, it's increasing, but the percentage that increase slightly slows down. Now this is the average cost of the debt since 1998. So we have calculated it for the total debt, foreign debt and domestic debt. As you can see, average we pay about 7.5% cost for our debt. That is the price of the price that we pay for our money that we borrowed. And the foreign debt we pay about 4.2%, and for domestic debt we pay about 10.8% in 2020, which is a far right graph, and you can see how it changes over the years over this chart. And here we show the increasing of the proportion of the debt servicing compared to GDP, that is our national production. So about 6.5% of our as a percentage of our entire production of the economy goes for debt servicing according to this graph. So here's what you call the international sovereign bonds that we have issued and the coupon rates. So as I mentioned, the coupon rates is the interest. So in 2007 October, we have issued international sovereign bond of about 500 million. If you look at the far left graph, is in the ash color is, I have given the grid. So basically the dark ash is about 5-year maturity. So the 2007 one will be matured in basically in 2012. So again, we have issued another 501 in 2009 at the interest rate of 7.4%. And in April 2010, we issued another 1 billion bond at the maturity of 10 years at 6.25. So likewise, we have issued so many international sovereign bonds till 2019 based on the different maturity. So as you can see, the multilateral debts, as I very initially spoke, those are maturing at like 20 years, 30 years. But as you can see, the international sovereign bonds, they are maturing at like 5 years, 10 years, 10.8 years. And also the interest rates are quite high, about 6%, 8%, 5.75%. So slightly higher interest rates that we have issued. So these are the international sovereign bonds that we have issued. And what we have done is, as I said, the coupon, like every 6 months, we have to pay the coupon. And to pay that coupon also, we have taken more debt by issuing international sovereign bonds and also borrowing it from the markets and also borrowing it from the bilateral. So that's debt snowballed, that it came to a point that we borrowed more money. I am repeating, more money to service our debt, to pay the interest at a higher interest rate. So that's which led up to this debt discussion that we all talk about. So that's the international sovereign bond. So these bondholders are all over. I'll provide a picture of who actually owns this bond. So if you look at our debt repayments, this is just to 2022 and 2023. We have to pay about, now everyone talks about the international sovereign bonds. We did a payment of 500 million on January 18th, and there's another one to be paid on July. So in 2022, as you can see, we have to pay bilateral debt of about, of course, Dr. Anil may have the most updated data, 577 million US dollars. And I have given the breakdown for China Development Bank, the government of Japan. So we have the breakdown. And also, as I said, these bonds are all also commercial banks. We have to pay about 58%. That is about 2.5 billion US dollars. And for export credit, we have to pay another 500 million. And for multilateral like Asian Development Bank, we have to pay another 700 million. So this is only the government debt. And also additionally, the private sector has also borrowed money in dollar terms, which we also have to pay. So according to our calculations, we have to pay about $4.4 billion. But I think with all together, some information, it's difficult to get, like the swap agreements and all that, their conditions. I think some figures have been quoted also as 7 billion to be paid this year. So hopefully about 6.5 billion after the settlement of 500 million on January 18th. We have given the number for 2023 as well. Now here, as I mentioned, shows now we can only borrow money as long as the market believes that we are good for money. And as you can see, that is mainly evaluated by the global rating agencies. So when you issue sovereign bonds, at least you have to, I think, get the ratings, if I'm not mistaken, from about 2 rating agencies. There are so many rating agencies, but basically there's a bigger, a higher degree of reputation for rating agencies called Moody's, Fitch, and S&P. So as you can see, every year there's this rating provided by, or their rating being provided by each group, each rating agency. And after 2019, basically our rating is, as you may have seen from the news stories, our rating has been cut down from B. So A1, those A ratings are like the higher ratings where people tend to consider the bonds are very secured. And from 2018, 19, actually our ratings have been downgraded. So at that point, the markets, as I said, are not willing to give us money. Of course, they will give us money, but the interest rates will be really high if you go back to the market. But at the C grade, actually, we are pretty much losing the access for the market. So now we have a problem that we can't roll it over because the markets are not willing to borrow us money to roll it over. And that's the challenge that we face at the moment. I'll quickly move to the last few slides. So also, as I said, the major banks have also invested in these international sovereign bonds and Sri Lanka development bonds. So as you can see, the Bank of Ceylon, Pan Asia Bank, Combank, they all have invested in different values on ISBs and Sri Lanka development bonds because that can be shown, that's shown in the balance sheet of these banks. So these are our stress indicators. So to pay that, our reserves, so since we have lost the market access to borrow from the market, we had to pay from our reserves. So our reserves are also slightly declining, and we have shown the reserves as a percentage of the publicly guaranteed external debt with comparing with a couple of other countries. So we are slightly at a lower rate compared to Bangladesh and Philippines. This is the lower, your most right top charts. And as you can see, the reserves and the other indicators are also slightly falling down. So this is the foreign debt by type. As you can see, our government strategy have been settling our ISB holders from bilateral debt. So as you can see very correctly, our ISB debt stock, which is like the dark purple, our ISB stock is reducing and the bilateral component is slightly increasing, and we are shifting for more multilateral debt to settle our ISBs. That's why it's reducing. And as you can see, if you look at the debt composition on foreign and domestic together, again, our ISB is coming down because we are financing from the reserves and from bilateral debt of ISBs and trying to change the debt mix on the portfolio. This is the debt ownership of our foreign debt ownership, mainly from the bilateral donors. Again, as you can see, it's Japan, India and China. I'll move very quickly for the best interest of time. And as you can see, Chinese and Japan having the bigger ownership of our outstanding foreign debt. And now the next problem is who owns our sovereign debt. So as I mentioned, when the central bank and the government issues these bonds, international sovereign bonds, through a lead manager, then these different investors, they buy these bonds. So the investors like BlackRock, Allianz, and all sorts of bondholders buy these bonds, whatever according to the disclosed data. But as you can see, 73% at the very bottom row are others. So we really don't know these, those who have these capital funds, these fund managers, this JP Morgan, and everyone has disclosed, but it's mainly the other bondholders. And out of those who have disclosed, it's mainly the United States, Switzerland, and United Kingdom. These basically US and European countries have purchased our bonds because they have their pension funds and different types of funds. And again, like these bonds, as you can see, it's not like any bondholder just keeping it for themselves. They are just floating. Now, if you look at the top row, the BlackRock, they had about 93,882, about 93,000 in Q3, but they bought more bonds for about $109,000. And then again, they sold, which dropped to about 104. So they keep the bonds, they are not keeping it, they are selling it, they are buying it again, depending on the market condition. So as you can see, all these companies, they keep it, they sell it. So it's like ISPs are not constant. They are the flows. It's like your stock. If you are investing in stock market, you're not keeping the stock constantly. You buy, sell, and you trade the stocks. That same thing happens with the interesting bondholders. So now there's a discussion about debt restructuring. In my view, debt restructuring would also not be easy for Sri Lanka, because as I showed you, our debt portfolio is diverse. So we have multilateral debt, bilateral debt, and financial market debt. So not any country will agree to take to restructure debt, because basically restructuring means either there are 4 ways of restructuring. One is they have to reduce the stock. We call it like we call the haircut. For an example, if Japan, since we own about 3.54 billion US dollars to Japan will say, okay, we'll calculate the interest rate for not for 3.54 billion, we'll calculate it for 1 billion. So that means about 2.54 billion is called the haircut. But no country will agree to take the entire haircut for them. They will ask to get the haircut for all the other creditors. So they will ask to take the equal share with Japan, with India, with China, and everyone. In fact, China, when our president requested the Chinese foreign minister in his recent visit, requested to restructure the debt, I think the Chinese Communist Party affiliated organizations mentioned that they are willing to restructure the non-concessional debt, but they also said the India and Japan and other countries also should jump in. So debt restructuring is also not easy, because our debt is very diverse. And if you are going for a restructuring, there are multiple layers that we have to restructure, because there's a club called Paris Club. So Japan is a member of the Paris Club. China and India are not member of Paris Club. So the Paris Club debt has to be negotiated at Paris Club, and you have to secure a deal with the Paris Club, and you have to negotiate with the non-Paris Club members thereafter. So that means we have to, whatever the agreement that we come with, the debt restructuring agreement with the Paris Club members, we have to come and negotiate with the same with the India and China, and then we have to go back and negotiate with the financial markets, and it takes time. It can take from 9 months to about a couple of years. Greece went through this. It's like debt restructuring is like now for them, like it's a never-ending thing. Argentina went through it. Ecuador went through it. Some countries had the capability to do it, but Sri Lanka hasn't done it. So I don't know. I'm not very confident about the debt restructuring process. It's a very complicated process in my view, because of the debt portfolio that we have. So my recommendations, my final slide is whether we go for a debt restructuring is not, it's I think very debatable, but I would like to put the reforms forward, because to overcome this problem, First, I recommend the state-owned enterprises have a lot of debt and they are very unproductive. So in my first recommendation is the state-owned enterprises have to make profitable. So basically it has to be privatized, and some has to be consolidated. Some has to be listed in the stock exchange and bring more private. But it has to be given to more private sector to work on these enterprises rather than state running it, because all these loans and these losses have to be borne by the common people and the government. So government basically had to borrow money in dollar terms and on rupee terms to finance the state-owned enterprises. I don't think that we can sustain with that. Sorry. So second, we have to move to the establishment of independence of the central bank and to have more competitive exchange rate. So that way we can make our exchange rate competitive. Third, also I think when we do these economic reforms, basically our poor people will get the highest impact. So for them, I think we have to have a cash transfer system based on market prices. When the cost of living is increasing, we have to increase their cash transfer, and the inflation is coming down. We have to reduce that so we can effectively utilize our funds. Otherwise, we are just like the Samurdhi program that we have. It's like a constant amount, and people who are not deserve Samurdhi are in the Samurdhi program. Who are deserved Samurdhi are not in the Samurdhi program. So poor people are most vulnerable when at a time of economic reforms. Fifth is we have to do like a grand scale deregulation. In fact, President appointed a committee called Lalit Veeratunga and Krishan Balendran committee. I think they have done some recommendations. We have to do a lot of deregulation on businesses so that the businesses can actually quickly pace up and present catch up the growth. And also I think we have a lot of tariff barriers that is reducing the competitiveness of the local industries, and we have to integrate with the global supply chains and increase the competitiveness. And also I think we have to freeze the government sector recruitment because that incurring a lot of cost to the government. We have to borrow more money to pay their salaries without any productivity. And I think we have to provide like a voluntary retirement scheme to the government cadre and bring down drastically the government sector salary. So that's my reforms. Of course, none of these reforms are very popular. It's politically sensitive, but I think given the debt stock that we have, pretty much exposed too much for the international sovereign bonds, since we have lost kind of market access, it's difficult for us to sustain if we don't do the reforms. I will stop from there. I'm sorry, I think I took a little more time. If you have any questions, I'm more than happy to answer. And thank you very much, Professor Vatawala, for the opportunity given. Thank you very much.
Thank you very much, Mr. Anandath. I think you went through in great detail. So, of course, the time factor does not matter because I think you had explained in detail. I will not go to explain anything because we have our very eminent panelists here. So we have Dr. R.A. Anil Pereira, who's the Director of the Economic Research of the Central Bank of Sri Lanka. He's just taken over on the 1st of January and of course has a great deal of experience in the central bank, and he's been there for a long period of time. So I'm sure that he will be able to explain. And of course, he's got a Doctor of Philosophy from the Monash University and a Master of Social Sciences in Economics from the University of California and a Bachelor of Arts degree in Economics with a first class from the University of Sri Jawaharlal. I think he has a lot of other employment records and also publications, which maybe I will not give, but I'm sure he's someone of eminence who can speak to us. Then we also have Mr. Adrian Pereira. He's a fellow member of our own CMA, our management accountants. He was serving as a member of the Council of CMA Sri Lanka till recently. And he's also a member of SEMA and served as the chairman of the ACCS Sri Lanka. So he's currently involved in the Lanka Rating Agency as the CEO director, and I'm sure he will also be able to make a valuable contribution. So first of all, I will invite Dr. Anil Perra to maybe to give his comments and maybe some more explanation of what the real picture of the ISPs.
So, Professor Watavala, I think I'm audible.
Yeah, okay.
Okay. Good evening, all of our listeners and the participants. And thank you, Dhananath, for comprehensive presentation from very basics of bonds to very comprehensive set of data. And I too actually enjoyed the presentation. Given the interest of time, let me elaborate on few things for the benefit of the participants. And as Dhananath too mentioned, Sri Lanka, we have two types of foreign currency instruments. One is ISBs and the other one is SLDBs. So ISB is more like it's commercial loans raised through the international markets. And as you are aware, countries raise funds through ISBs, so for various purposes, including budget financing, and also for some, when you identify certain projects to finance those projects, even you can go for markets, and also for reprofiling your debt portfolio, and also for various certain needs. Now, Sri Lanka, of course, went to this ISB market in, if I'm not mistaken, in 2007 period, because we lost the access to, concessional funding when we became a kind of a lower middle income country. So we had no other option to go for the, other than going for the commercial market to raise money for our funding needs. So from that point onwards, our ISB portfolio has grown, as mentioned in the presentation also. So by the end of 2019, we had something like 17.5 billion ISBs with an average tenure of 8.3 years, and also at an average rate of 6.6%. So we have seen some gradual build-up of ISBs, and starting from 2020, there has been a reduction given the policy or given the strategy in terms of debt structure, and there has been a reduction. Now, if I give you some background on the current strategy of this handling ISBs, now what we are looking for, given our exposure to foreign debt, and also given the high exposure to the ISBs, the strategy is very clearly to reduce the ISB portfolio. Now, if you look at the ISB, the percentage in terms of a percentage of our GDP, now at the beginning, and also as I said, there was a gradual build-up, but we were trying to maintain kind of a reasonable ratio in terms of GDP. So ideally, less than 10% ratio would be, I think, some tolerable ratio for an economy like ours. And at the beginning, actually, until about, I think, 2004-05 period, 14-15 period, I think our ISBs were something like 5 to 6% of GDP. So thereafter, I think we have seen some gradual or kind of a rapid increase after that gradual period. So it went up to around 17-18% of our GDP, so which is a sizable amount. And now what we are trying to do is basically to reduce this exposure. As you are aware, last year we have paid some ISBs, and this January we have paid another 500 million, and in the coming month of July, we will be paying another 1 billion. So as a result, we are trying to reduce our portfolio of ISBs going forward. Now, right now, we have something like 12.5 billion worth of ISB. That's even a kind of a higher amount. So the strategy is very clear to reduce the exposure on ISBs going forward. and also to look at looking for some alternative financing strategies in international markets, maybe government to government, some similar arrangements would be the strategy going forward. And also, as Dhananath mentioned, I think if we look at our debt, the total debt portfolio of the country, there's no argument. We have seen some increase our public debt. So it should be reduced. I think even from the perspective of the central bank, what we really expect from the government also a kind of a very strong path for fiscal consolidation. So fiscal consolidation includes the reducing the budget deficit as well as the debt component or the debt ratios on a sustainable basis. So we are also into that, that ideology in terms of sustaining the debt component of the country. So that is something I want to highlight. And also picking up from the Dhananath presentation, couple of points I would like to highlight. I think these reforms, I think it's a very important point. I also agree with certain proposals that he had made, especially with regard to these SOEs, state-owned business enterprises. And we have seen these SOBs are basically making, most of them, at least the large SOBs are making sizable losses, which is a kind of a burden to the economy going forward. And we think there should be a sustainable solution for these SOBs, especially in terms of cost-reflective price adjustments. So we have seen some price adjustments for certain SOBs in relation to the products of certain SOBs last year. But I think going forward, when you look at the international price movements also, there is some space to adjust further of these rates. And some of the utilities have not been adjusted for nearly a kind of 8-9 years or even a decade. So we have to have some strategy that we basically focus on the sustainability of these SOBs and also the impact of these SOBs not only on the government debt and also on the banking sector. So that has to be addressed in a sustainable manner. So those are my few remarks given the interest of time, Professor Vastavela. Maybe based on the questions that would arise, we will basically respond going forward. Thank you.
Thank you very much, Dr. Anil. I think you explained in detail. I'm sure there will be a few more questions. All those who are sending questions, kindly send it on the Q&A, because then it will be easier for us to take one by one and give you the necessary answers. So now may I invite Mr. Adrian Perra to give his comments and any sort of remarks that you would have.
Okay, thank you, Professor. Thank you, Dhananath, your comprehensive presentation. I think there are very revealing facts. I was trying to, since you have taken it up, I just reveal that. And thank you, Dr. Anil. Dhananath actually explained, I think the big initially that why we need bonds. That is the crux of the problem. If an entity is borrowing, they must either use it for investment purposes sufficient to recover the return. Okay, you can use sovereign bonds for reserve purposes, but not to a large extent. So that is number one. That is where we started using that sovereign bonds to keep the local domestic prices low. So that is where the first mistake. And most of the today's discussion is, and I think everybody is discussing about whether these defaults and those things. Actually, if you look at defaults, considering from 2019, out of all the countries that have gone, it's not more than 10 to 15 countries. But on the other hand, after this COVID situation, some of these things have come into light. G20 countries came up with DSSI. Of course, 41 countries to restructure their bilateral debt. But that only solved, if you look at it, the liquidity matter, but not a rating when it comes to pricing issue. Now, if you look at even now, I agree with Dhananath, this debt restructuring is not an easy task. There are 3 countries because there are a lot of debt. Like a country, like if you look at Sri Lanka, there are a lot of parties into it. So it's like I'm going and telling a bank, I don't have money to pay. Can you restructure the debt? At the end of the story, when it comes to the bank, the whole banking sector is not going to look at me positive. And when you have about 12, when you have a lot of parties, they will not respond, and that's the end of the country. And debt default is also not a solution, because the countries that defaulted debt, like Argentina and Lebanon and Libya and all those countries, South American countries, that's going to be the end of the story. Sri Lanka will never be able to come out of the hole. So whatever said and done, we have to pay the debt, especially the ISB. When it comes to the bilateral debt, it's easier to restructure rather than going to ISB, trying to restructure the ISB debt. So, and I agree with Dr. Anil saying that definitely there are certain utilities, the pricing adjustments have not been done. So we need to relook at this utility sector. There are certain pricing, whether we can look at revising prices. But of course, it's a political issue. And I don't agree, not that I don't agree, I agree, but privatization also similar word. All countries, all governments in Sri Lanka, we know that try to privatize or whatever you can call it, whatever name, end of the day, next election, they were thrown out. So it's not an easy thing because there's a political issue, there's a social issue. And so these things come into play. It's easier said than done, whether it's economics or no economics. So I would look at much better way, easier way of looking at, there are certain underutilized assets in Sri Lanka. If you look at the Hyatt, I don't know why they are not doing it. Where nobody will bother to protest if selling Hyatt residencies, that tower, try to get rid of those underutilized assets to foreign investors ASAP. And the most important thing is how to attract foreign direct investment to Sri Lanka. So we need to expedite. I think Professor was chairman of BOI some long time ago. So we need to see how we can expedite and get the foreign investors to come into Sri Lanka and get their documentation sorted out. Now, the current scenario, even for a local investor to go and invest, it takes, you are lucky you can come out of it after putting the application, getting the environmental, getting all the license and all that, if you can get it done with 6 to 8 months. Now, in a competitive market, competitive world, and asking a foreign investor to say 6 to 8 months and going from pillar to post is not going to solve the problem. We need to look at how best and how fast we can get the documentation sorted out at one location. So we need to look at that central coordination agency somewhere, I don't know whether it's BOI or Port City or wherever it is, how to get this FDI in and make it attractive. And another way of we can look at it is, as you know, Sri Lanka imports even fish. So sad part, although we are surrounded by the sea, we need to look at how best we can cut down these unnecessary imports and increase local production. Because it may be small amounts, but over a period of time, it has accumulated to such an extent that is creating a burden on the local economy, especially the foreign borrowing and the foreign reserve. And try to also try to stretch the local debt to much as possible. And so bringing in FDI would be the only way out. I don't see any other way out on this. But trying to default or trying to go for debt restructuring at international level, we will not solve the problem. We are going to only aggravate the problem. So whether this debt is sovereign or local, because they will just definitely going to ask everybody to take a cut, and by the time they come out, it will be 1.5 years to 2 years. So I think by then this issue has got aggravated. So what we need to look at it, how best we can look at certain industries, certain sectors in the economy where they can, where the productivity and they can produce locally rather than importing the stuff. So we can call it privatization, but privatization, if you know, if you go to do that, it's going to be a political issue. So we are to look at that side, because we can't segregate this political issue from the economic issue, whatever said and that. So you don't work. Practically, it will not work. So my solution to this is, I think we need to attract more foreign direct investment. So as you look, if you look at Gananath's presentation, this problem didn't start 2019 or due to COVID. So only COVID opened our eyes. Otherwise, we would have kept on going this, taking this, going in this same. So if you look at the rating agencies have started downgrading 2016-17. So you can't blame them. So in one sense, so COVID only opened our eyes to say, look, this won't continue. This you cannot continue like this. You need to stop something somewhere. So, and if you look at it, we have been borrowing and our sovereign, our reserves have been not solid reserves, but borrowed reserves. So you can't continue like that. So we need to get in solid reserves. Only way you can get solid reserves is either through FDI or through net exports. So if we can get those two sorted out, I think the country can get out of it. So we need to curtail certain imports, no doubt. I agree. We need to curtail certain imports. We will have to take the pain now for the comfort as a country we got for 30 years, we were misusing. I think that's my point. If there are any questions, I'm willing to answer.
Thank you, Adrian. I think one matter that was mentioned by Mr. Adrian is on the FDIs. Dhananath and Dr. Anil, I don't know whether you want to comment on that about FDIs, because there was nothing mentioned in your talks about that matter. Dhananath, you can go first.
Yes, Professor Badal. I think you are the best person to talk about FDI since you have hands-on experience. Yes, I think that if now we have to look at this entire problem as a whole. Of course, I think FDIs is one way of overcoming this, because when we have FDIs, we can somewhat balance the cash flow when the money is coming in. But now it's like a chicken and egg situation, because of the drying out of foreign reserves. Of course, we have seen some issues. The ministers have spoken about the difficulties that they are having to bring down fuel and electricity and all that. So the foreign direct investors are not going to look at very positively when you have those basic, reliability on the electricity and all that. Sometimes they are slightly concerned. And also, if you look at our foreign direct investment over the years across all the governments, it is basically not after that. I think that apparel industry, it's very few companies thereafter have coming in. It's basically the same companies like Dialog and this telco sector. They are reinvesting their money. It's not like the new investors coming in. So that is a challenge that we have to face. Indeed, our foreign direct investments are not performing well. And I think I had a lot of trust on Mr. Mohottala, but unfortunately we saw how the trade union pressures were coming in. And I think he was a very capable gentleman in my view, but he couldn't, he resigned. And it was not him first. So earlier, Mr. Susantha Ratnayaka was there. He was also, in my view, was a capable gentleman who headed one of the largest conglomerates in Sri Lanka. So when you move those heads quite often, the strategy and implementation becomes difficult. And Mr. Vatavala will witness, if you look at our BOI, which is like one of the main drivers of foreign direct investment, our cadre is now, I did an interview with Mr. Mohottala. He said he has about 8 people who can go and pitch for these investments, where you have a very bottom heavy, thousands of employees are, I'm not discriminating on their designation, but they are mainly the worker category and the labor category who is in the cadre, which most of his funds are channeling there, while he has about 5-6 members who can go to an international forum and do a pitch to bring the investments down. So very, very difficult in that sort of a context to bring investment. So I think those restructuring, it's not easy. It's painful. I'm sure the trade union pressure is going to come in. We can't avoid it. But I think we have to somehow have the courage and get those things done as a country to overcome this. Otherwise, there is, without hard choices, we can't make this overturn. That's my view. But it's easier to say than done. I completely admit that we need some character leadership on getting these things done.
Thank you. Thank you, Dr. Anil. You have any comments?
Thank you, Professor Vatawala. And I think it's a very valid point. And that would be the most sustainable and organic solution for this matter, having more FDIs. And we have seen successive governments have been trying to get FDIs based on their targets. And we have seen at some cases there has been some success and some failures. And as a result, FDIs have been volatile. But compared to, I think, the previous, past few over the years, the experience, now we have some fertile, basically a background to attract more FDIs. One which I would like to, I think, refer is the port city. So that would be, in my view, could be a game changer if we devise certain mechanisms, some plans, appropriate rules, regulations, and the facilities to attract more FDIs. That's one aspect. And the other thing I would like to say, there are, I think, areas that we can focus on. One area would be invisible exports, mainly the tourism sector. I think the tourism sector, what generates as foreign exchange is, I think, in my view, more value addition is there. So that is one area that we can focus on. And also, I think the government has also very rightly identified there are a lot of underutilized assets. If I look at from my office around, I can see there are various places which have not been utilized effectively. And at the same time, I think under UDA, 6 billion worth of assets have been, non-strategic assets have been identified that you can basically monetize them and get some flows and use those flows in a productive manner. So those are some areas actually that we can think of in terms of getting more inflows to address this issue. And I also agree, and I'm very pleased to note that point from Mr. Adrian, this default. So a lot of people were speculating and also forcing that the Sri Lanka should default at this stage. But I think it's really damaging, that would have, repercussions for generations. If we think of defaulting of any other loans, especially to international investors. So I think the strategy should be to honor our debt obligations as we have done in the past 73 years without any issue. And at the same time, to devise a strategy that we should attract more flows to have some surplus. Thank you.
Thank you, Dr. Anil. No, since Dharnath mentioned, I just want to tell about the BOI. The most, I think, what they should do, of course, they need immediate restructuring, but that will be able to solve some of the major problems that they're having. What they should do is that, they have the zones, So really, most of these people who have been taken are people who are not going to be involved in the promotion, but maybe more suitable for the area of running the zone. So if they separate out the zones, because that is now, say, if you take Katnayaka zone that is running very profitably, then maybe Biagam is the same. So most of the zones are able to manage on their own. So if they separate that out, the promotion and investment area separately, and then the running of the zones, then definitely they can get a number that would be can be controlled and could be a very, very high quality staff who can do the promotion. So that's my comment on that. But I will take a few, there are some few questions that have come. One is we need drastic action on quality of economy by improving inflow and drastically curtail outflow. The beneficiaries are rich and upper middle class who had to bear the brunt and not the poor. For example, the 136 billion spent on highway could have, Kandy Highway would have been used to improve our rail stock and improve fuel efficiency. Would anyone like to, maybe we can make a brief comment on that if it is applicable? Would Dr.
Professor, can I comment?
Yeah, okay, right.
A part of it only, this there's a comment on this highway and rail stock and all those things. I think We need to, when it comes to these highways and large infrastructure projects, we need to relook at this model. We have our construction sector, which is road construction and infrastructure development. First one, we are used to borrowing money and building roads. Now we need to relook at how other countries did, not this multilateral institution, what they preach. So if you look at how Mahathir Mohamad did develop Malaysia after the Asian financial crisis, right? He got the corporate bond market and developed the infrastructure and developed the whole. Recently, they opened the first overbridge highway, which is of course purely funded and constructed by local parties. So that actually, when you build certain highways, it develops a certain sector, certain regions equally. Because these highways was built only from Colombo to Galle, we can go to Galle in 1 hour. Otherwise, it was a day trip from Colombo to Hambantota. It was I remember in 2009, I went, I started at 3 o'clock. I was there by 1:30 in the evening. So there is a requirement for highways. There is no doubt on that one. Definitely, I 100% agree with that gentleman that we need to develop the railway sector also. So in addition to our education sector, so we need to build in a manner where there is more GDP multiplier effect to the economy rather than borrowing money from overseas and sending money overseas for the highway. So we need to relook at this model. I think we need to look at models for how Malaysia did, how China is doing, how Indonesia did, how Pakistan is working through this one. We need to relook at this model, especially the construction of our infrastructure model. Borrowing money and doing it's not going to solve the problem at this point.
Okay, thanks, Adrian. Dr. Anil, maybe a short comment from you.
I don't have much to add, Professor Vatavale, but I think this argument on highways, I think when we didn't have any highway in this country, I remember people were talking about having a highway. Now we talk about having too much highways or spending too much on that. But in my view, I think it should be an integrated approach, which means there could be some areas strategically you need highways, and at the same time there are some areas that you need to strengthen your railway network and also some other modes of transportation. So without, I think, looking in isolation, if we can look at in a kind of a integrated approach or holistic approach, I think that would be the ideal. Then it will help to get the maximum out of the highways or any other transport or the road network effectively. That's my brief view.
There is a question here. Central Bank of Sri Lanka says that they are actually restructuring debts by buying back the financial bonds. Whereas some say this is not debt restructuring. Generally, restructuring means extending the period of the loan. Can you emphasize on this aspect? Dr. Anil, you like to comment on that?
I think this was basically discussed by Ms. Adrian also. Now, restructuring could have different definitions. Different institutions could have different definitions. And whatever we take the definition, I think most involved basically looking at maybe buybacks or extending the time or changing the structure or rates, etc., etc. But as I think in many occasions we have mentioned at the central bank, what we are trying to do is basically create some space in our debt portfolio. And as a result, as I already mentioned, we are looking for some new sources. And also one part would be the monetization of these non-strategic assets and also some G2G arrangements and central bank to central bank arrangements to create some space. So all these are actually falling into the same equation. So it's also a kind of a different way of restructuring in that way. So I think rather than looking at in terms of, I think these some of the institutional views in terms of restructuring, what we are as a country also trying to do is a kind of a reprofiling the debt in terms of creating space, and as a result honor our debt obligations on a timely basis without having any issue.
There is a question on ISPs. There would be natural decrease of ISP percentage composition due to inability of accessing market for new issues. Are we considering repaying the upcoming maturing ISB? Or restructuring, ISP restructuring. That is about the repayment. Those two things I thought. Dr. Anil, you like to speak on that matter about the ISP?
I think, Professor, what I have mentioned already, we have already paid our ISB obligations so far, and going forward also we will be paying our ISBs on time.
Yeah, I think what he's asking, what are the short-term, medium-term, and long-term solutions for this problem?
Even for that matter, I think in all three speeches, what we mentioned was there should be a kind of a clear strategy that we should have a kind of a strong fiscal consolidation going forward. That could be our medium to long-term plan. But we in the short run, I think we should basically look for cash flow improvements in terms of paying our debt, because we have to be mindful that in the good times we have been paying without any difficulty. Now this is a difficult time for everyone. Even within the difficult time, we are trying to find out some alternatives to on our obligation, not only the debt obligations, maybe other obligations also. So it's a mix of, I think, strategies.
Thank you. Dhananath, you have any comments on that?
Basically on the restructuring, I think now as the gentleman has asked the question, since we are not going to the market to issue further issuing bonds or rolling it over, we are basically buying it, we are settling it from the bilateral credit line. So basically the ISP should come down. And as I think Dr. Anil mentioned, there's a bit of a flexibility when it comes to negotiating with bilateral debts because of the relationship between countries. So that's there. But we have to be very cautious, because as famously said, there's nothing called a free lunch. So we are also somewhat, this can be like a geopolitically, it comes to boiling to at one point on these geopolitical sensitivities as well. So in the modern world, the debt restructuring is no longer like just a debt problem. It's there's a international issue, there's a geopolitics issue, there's a credibility issue, there's everything comes all together. So it's a very tricky, it's not an easy time. I can only wish good luck to Dr. Anil Pereira and all the officers at Central Bank, because it's very challenging, which I think we all have to understand, and we all have to support them with our views and with what needs to be done. But it's ultimately the government's call, and also some of this information is only exclusively available to government. For an example, like the swap agreements, what is the condition, whether it's like 5-year swap or like, generally swaps are considered like short term, 3 months, 6 months, 9 months. But how are they going to manage it is better known to the government. So, but we have to be very careful when we are managing those instruments. It's not an easy time, as we all know. It's a challenging time, but we have to build up the credibility. But as a think tank person, I will always put reforms in the forefront. Always do the reforms, structural reforms. That's the way out. The more we delay it and more we try to juggle with it, the more we cornering ourselves to the wall. Then we are limiting our options. We should not limit our options. We have to try to do changes as much as possible, because I myself has been in this investor room, and you won't believe, like in New York, when they before invest, like they all have like the dashboard of our credit rating and indicators like economic freedom or the Fraser Institute. So they just check like, okay, look, we are country, this is the profile. They go through very detail on these parameters. So it's not easy without doing those reforms. So when we go to the negotiation table, investor table, we should always have it in backup, saying this can be done, and we are more for investments. I'll stop from there.
Thank you, Dhannath. Now we think our time is up. So what I would like is get our panelists and the speaker to give their final comments. So can I start with Mr. Adrian Pereira? Maybe short comment.
Yeah, thank you, Professor. Professor, now everybody is looking at this. We got a CCC rating. So I think when you were the BOI chairman, you never had a rating. I think you are very comfortable in rating investment. So we don't need, as a country, we need to worry about it, but we don't need to worry about it when it comes to FDI per se, because we are at the bottom of the lake. So you don't need to worry on that one. Only thing we need to ensure how fast we can get the FDI application signed out and make it convenient for the investor. So otherwise, if things are not, whatever rating it comes, it doesn't matter. So because if the investor can't, because if you look at Vietnam, Cambodia, China, I'm sure there are more issues to go through, but they are very fast in approving applications. So I think we need to look at how fast we can get this BOI, FDI approved, and some policy decisions like monetizing certain assets. I think that decision making has to be expedited. So otherwise going this restructuring won't work. So and also I beg to differ, because this policy, certain policy decisions like privatization will not work, not in Asian context, South Asian context at least. So we need to expedite and get our FDIs in order. When, of course, since we enjoyed for the past 30 years, now I think this past couple of years, next couple of years, we'll have to bite the bullet a little bit to pay the debt off.
Thanks, Adrian. Dr. Anil, can I invite you to give your final comments?
Thank you, Professor. And as I said, the strategy, current strategy is basically to reducing our ISB exposure. As I've already mentioned, with the payment of this 500 million in January, we were able to reduce our ISB exposure by around 17%. And with the July payment, we will be able to reduce it by another 23%, further 23%. So which means we are basically into that path. And as I said, sustainable level would be compared to our GDP levels and also compared to our inflows to have some, reasonable size of ISBs. That's one thing. The second thing, we all agree some reforms are needed, especially in terms of the fiscal consolidation is very important, paramount. And also we agree without putting much burden on the economy as well as on the government, on certain fronts, some certain SOEs have to be reformed. Those are some essentials. So all in all, I think we all agree. I think we have discussed these things most of the time. There should be some commitment from all aspects to make it very sustainable and for the benefit of the economy and the mass. Thank you.
Thank you, Dr. Anil. Can I invite Dhannath to give his final comments?
Yes, Professor, thank you very much, first of all, for inviting me. It's an honor to share the forum with Dr. Anil Pereira and Ms. Adrian Pereira. I think, as I said, reforms is my prime focus. I agree that the reforms can be in multiple forms, but I am more for privatization, to be honest, because I believe there have been very successful privatizations under this government. Now, for an example, CICT, which was done, which is like one of the main revenue generations in the shipping industry, and SAGT, and even Sri Lanka Telecom that we did. We have very successful case studies likewise. And indeed, the Trincomalee oil tanks, which was very successfully done, I think these are good case studies. Of course, I understand there's a lot of political sensitivity, but I think this government really have the capacity to do it because they have the 2/3 majority and the political will. And there are multiple options. Privatization could be listing on the stock exchange. Already the BOC and the electricity board has been listed in the Colombo Stock Exchange, but we haven't issued shares. So I think there are multiple options that can be done. I'm not saying like everything to privatize. There could be consolidation. There could be debenture issues. There could be multiple options that we could consider in terms of increasing our productivity. because private sector has really shown. Of course, the private sector has a lot of flaws. They are not perfect, but I think they have brought a lot of revenue, and they have shown a lot of positive traits in challenging times. They have always come forward. We have to empower them. And secondly, in terms of reforms, I think these reforms, of course, causing poor people a lot of burden. We have to take care of them, because at a point of currency depreciation, things like that, they will be the first line of impact. So we have to take care of them. We should not forget them. That's the second point. Third, I think the reason why we haven't been focused performing on FDIs and on our exports, mainly due to the problems with also somewhat on our monetary policy. I think we have to integrate with the world. If you look at the examples Mr. Adrian took, like Vietnam, Malaysia, they are very, very, very fast integrated with the world. In fact, Vietnam has signed so many trade agreements with multiple other countries, where we only have like one or two. Even the Singapore agreement that we were discussing, we couldn't materialize it. And now I'm very happy that seeing that we have in discussion with China and Bangladesh on more free trade agreements. But I think we have to do a lot of reforms unilaterally in the first place. That's the way to attract more foreign direct investment. But I think the investor sentiment also have changed over the years. There are a lot of options they have now, because our neighboring countries like India, even Tamil Nadu, and the economy is growing in Visakhapatnam, Malaysia, Bangladesh. They have a lot of options for investors, unlike 5, 10, 20 years ago. So we have to really be competitive with them, because they are attracting most of our investors, like Apple now have invested in India, and so in Vietnam, their AirPods are manufactured in Vietnam. So there are better options. So we have to be really competitive with them. For that, the investor will look at the overall aspect, the connectivity, the investor sentiment, and all that. So even in ease of doing business, which was like now scrapped down from the World Bank, we were not doing really well. Even India jumped so many rankings, but we were quite slow. So I think we have to look at the overall aspect and thrive. I'm very confident Sri Lanka can, but reforms has to come to the forefront, and we can do this.
Thank you very much, Dhananath. So let me thank everyone. But just to make, I think some of the matters that came up, I think one is, of course, on the international sovereign bonds. I think we are very happy that Dr. Anil, who's here from the Director of the Economic Research Division of the Central Bank, where they want to bring down the ISP. So I think that's a good thing. But I think the million-dollar question is how we are going to generate the income in order to repay these loans. So if we are going to take another loan, then we are going to be in trouble. So that means what you mentioned about reforms has to come in definitely. So without reforms, you can't go. And even in reforms, you also need to improve the management. I feel that SOEs is something that a matter that we've all discussed in detail. But if the management structure, the management of these SOEs are improved, they are made accountable. And as Dhananath mentioned, where either you list them, means you don't have to issue shares to anyone, but you have a separate stock exchange where at least they will submit their accounts annually on quarterly basis, similar to the public quoted companies. So it's a matter of having proper management. If the government is able to do that, select the right people, give them the authority, and also make them accountable, so that if they do something wrong, then they are accountable. Because today we see a lot of things that are happening. They easily come and say we will pay compensation, but that is not the case. You have to make them accountable, otherwise it will not happen. Then about the ratings, I think it is very, very important. Although we may think that is not valid today internationally, we are gone into a different, maybe a very, very maybe advanced state where ratings are going to be valid. And of course, like what Dhananath mentioned, that the government has a majority in the parliament, and then they can take certain decisions which will help in the economic development. So I think that's another advantage that they're having, which they should use for the improvement, carrying out these reforms and the fiscal consolidation and all these areas. And on the free trade agreements, unfortunately, people are looking at free trade agreements only for imports. I think if that is the case, it is not really going to help us. We need to look at how our exports could be generated, where FDIs will come in, the exports could be increased so that we will have a lot of money and foreign exchange available. So this today's our webinar is really an eye-opener, because as I said, our main theme is to on the main theme of getting over the government debt problem. So while we discuss ISPs, a lot of other matters have come up, and we are hoping to carry out a few more webinars on the important areas that came up, even on the reforms, on the SOE restructuring, because especially for us on the management accounting, the financial accounting area, these are quite valid, and we should really attend it. So once again, let me thank Dr. Dhananath for that very excellent and very detailed presentation. As I said, at the initial stages, we are more involved in the income and expenditure and cash flow and other things, but now we really know how these monies are coming in and how we can reach the deficit, and also maybe we can fall into the problem like what you gave on the debt problem, which can be a major, is currently a major problem for the country. And we are very happy that Dr. Anil Perra, who's just taken over as the director of the Economic Research Division of Central Bank. He's someone who's with great experience. He's been with us, I think, maybe 2-3 years back. He was there. He made a very, very good presentation. So today, he's also told us that the thinking of the government, what they want done, because the central bank, of course, as you always know, is a think tank, but there should be the people who will carry these out, because if they do not carry it out, then unfortunately the policies that are framed by the central bank cannot give the results. So especially the reduction of the ISPs, but connected that will be how we are going to pay it, not by borrowing, but we need to generate our own foreign exchange, our activities in the export sector and foreign direct investment and everything that is there. And of course, I'm very happy that our own member Adrian was there. He spoke on some of the more important areas, because he's now involved in the rating area, and I'm sure that he will be able to make a big contribution in this area, and that a lot of the investors and others would be able to benefit. So let me thank all of them, and let me also thank all our participants who have been present here and listening to this. And I'm sure that we are going to have a few more webinars connected with these topics. And if any of our participants have any suggestions of what they think are appropriate and what we should do, and also connected more with as management accountants and also on the financial accounting side, how we can bring in, because the budget mentioned a lot of those areas, but we now have to go into more detail and give as to how this could be done and what is the benefit that will flow to the people. So let me thank our speakers, as I said earlier, Mr. Dhananath, Dr. Anil and Mr. Adrian, and all our council members who have supported in this area, and all our participants. And I wish you all the very best, and that you will be joining us also for the next few webinars that we will be conducting. So let me thank everyone and wish you all the very best.
Thank you, Professor.
Thank you,
Adrian.
Professor.
Thank you. Thank you, Dr. Anil. Thank you, Dhananath. Thank you very much.
Thank you, Anil.
Dhananath, if you can have your presentation, that will be good, because a lot of them might like to have it. I think it's gone, I think, but it's okay. Okay, thank you. Then we will now wind up. Okay.